If a week's a long time in politics, 2 years is an eternity in monetary policy. 2 years ago, at a time of heightened uncertainty, the MPC instituted a comprehensive package of measures, including cutting bank rate to a historic low of 0.25% and purchasing an additional £70 billion of assets. Today, the MPC is raising bank rate by 0.25% to 0.75%. 2 years ago, the UK economy had substantial spare capacity and domestically generated inflation was low. Business confidence had fallen sharply to levels last seen in the wake of the financial crisis. Inflation was expected to overshoot its target, but overshoot it entirely because of the sharp drop in sterling, which itself reflected the view of financial markets that Brexit would bring a large negative shock to UK relative incomes. In these exceptional circumstances, the MPC rightly chose to support jobs and activities while it extended the horizon over which inflation returned to target. That strategy has worked. Today, employment's at a record high. There's very limited spare capacity in the economy. Real wages are picking up, and external price pressures are declining. With domestically generated inflation building and the prospect of excess demand in the economy emerging, a modest tightening of monetary policy is now appropriate to return inflation to its 2% target and to keep it there. UK growth in the second quarter is estimated to have rebounded, as expected, consistent with the MPC's judgment that the slowdown in the first quarter primarily reflected the weather, not the economic climate. Construction output rose in May at its strongest rate in 2 years. Retail sales grew at their fastest pace in 3 years. And broader survey indicators of output growth have been in line with the committee's expectations. In the MPC's latest expectations, conditioned on the gently rising path for interest rates implied by the market yield curve, UK demand is expected to grow at around its current pace. Household consumption is expected to grow at a modest rate, broadly in line with real incomes. With continued support from external demand, limited spare capacity, the relatively high rates of return on capital, and the low cost of finance, business investment is expected to expand at an annual rate of around 3.5% over the forecast period, a subdued pace relative to past recoveries, reflecting the drag from Brexit-related uncertainties.